Welcome to RBC's Markets in Motion podcast, recorded March 24th, 2025. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. The big things you need to know? First, trends and investor vibes were mixed last week, both in our quant work as well as last week's investor conversations. Second, the median forward PE for the S&P 500 has fallen sharply, but remains well above average. We've also not yet seen significant adjustments to consensus earnings forecasts, which seems likely to keep confidence in PE analysis low for now. Third, small caps, which have seen a greater degree of valuation correction, have continued to outperform large caps. If you'd like to hear more, here's another 5 minutes. While you're waiting, we do have some good news to share. I was honored to be named to Barron's list of the 100 most influential women in U.S. finance for the second year in a row, along with fellow RBC strategist Halima Croft. Now let's jump into the details. Takeaway number 1. Trends and investor vibes were mixed last week. It felt a little bit quiet in the U.S. equity market last week. Other than the Fed meeting, the most notable development on the data front from a U.S. equity market perspective was the mixed retail sales report at the beginning of the week. In our meetings with investors last week, we did find a few common threads. First, tariffs and the challenges they pose to corporations, particularly those who had moved production to Mexico, remained highly in focus. Second, April 2nd was in focus as an opportunity for the narrative around tariffs to shift. And third, equity investors were debating whether U.S. consumers were actually pulling back on their spend or simply shifting what they were spending their money on, with a bias towards the latter. While most investors we spoke with seemed more keen on the idea of seeking out opportunities in parts of the U.S. equity market that have seen some valuation opportunity unlock, we also sensed a need to get more information and to get through a cycle of potential earnings forecast adjustments in order to be able to proceed with any degree of confidence. Looking at data, there weren't too many quantitative updates on the vibes or departures from the trends in them that we've been highlighting over the past few weeks. Here's what we learned on the quant side that's incremental. Trends and investor vibes were mixed. Net bulls on the weekly AAII survey, retail investor sentiment, remained quite weak, with net bulls once again more than 2 standard deviations below the long-term average and down at levels associated with the 1991 recession, the financial crisis, and 2022, when the Russia-Ukraine war and inflation spike occurred. On a weekly basis, net bulls came in at minus 36.5%, with the 4-week average down at minus 38.9%. Meanwhile, on the institutional side, U.S. equity futures asset manager positioning per CFTC's weekly update has continued to fall, but remains in the early innings of its decline, which we think accurately captures the tone in our conversations with equity investors over the past few weeks. Meanwhile, signs of stress in the options market did ease, with VIX, RVX, SDEX, TDEX, and MOVE all coming down. Bitcoin, which has been aligned with the S&P 500 recently, also crept up. Despite a continued push into Europe and Germany in the EPFR funds flow data, we did find that flows to U.S. equity funds picked up just a little bit. Shifting gears to corporate vibes, a new to us data point on corporate vibes highlights recent deterioration. We initially missed the update to Chief Executive Magazine's CEO survey that came out March 10th, but caught up with this release last week as we were reviewing our charts on C-suite sentiment. In that survey, which was conducted in early March, CEO confidence did fall sharply, with a worse drop than what we saw on the Business Roundtable survey. The declines in both of these surveys stand in contrast to the increase in CEO confidence that was seen on the Conference Board CEO Confidence Survey released back in February. The Chief Executive Magazine survey results highlighted deterioration in views on current conditions and expectations, heightened concerns about tariffs and an economic slowdown, and an expectation for higher prices. Our work had been suggesting that corporate vibes have been holding up better than consumer and investor vibes, but the recent corporate surveys are telling us that the corporate vibes may have seen some of that resilience erode as well. We'll have a better read on the state of corporate vibes once first quarter earnings season ramps up in a few weeks. Moving on to takeaway number 2, S&P 500 valuations aren't cheap yet. The median PE of the S&P 500 is down to 17 times, a big improvement but still well above its long-term average of 15 times. It's tough to have confidence in forward PEs right now, given the need for earnings expectations to be adjusted, but we still find it useful to keep an eye on the trends here. In our investor meetings, some have asked whether the recent rotation out of the U.S. and into Europe might soon reverse. On the U.S. side, we don't see a valuation justification for a big move back in yet. Meanwhile, downward revisions to consensus S&P 500 earnings forecasts have been modest, with 41% of revisions still to the upside on the 4-week average as of our last update. We'll wrap up with takeaway number 3. Small caps are holding up pretty well. Small caps have continued to outperform large caps. With the Russell 2000 market cap weighted forward PE still down at 14.3 times, well below the 15.1 average, we are comfortable nibbling here as there's simply been more valuation improvement. We would, however, like to see positioning in small caps per CFTC's U.S. equity futures positioning data come down a bit more. In investor meetings, we've been noting that the small cap part of the U.S. equity market does seem less exposed to U.S. outflows by investors moving money into Europe. That's all for now. Thanks for listening, and be sure to reach out to your RBC representative.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.